So while Canada's total trade exports rose by 1.1% for May, the share of export to the U.S. actually shrank to the lowest level it's been since 1997, excluding the COVID period. For more on what this means to the Canadian economy, I'm joined by Shelly Kaushik. She's senior economist with BMO Capital Markets. Thanks for coming in.
Hi, thanks for having me.
So if the Canadian plan has been to diversify away from the U.S., and obviously it seems to be working, let's talk about what other nations, for example, we're seeing trade go to.
Yeah, I mean, I would first off start by saying this is very, very, very early days in this, new trade environment.
Yes.
New trade environment, diversification, buy Canada, don't buy U.S., what have you. It's still very early days. So these latest data are as of May. So only the second month since the Liberation Day tariffs were announced. Now, what other countries are getting it? Again, it's very hard to tell. It's hard to draw any strong conclusions or trends from just 1 month of data. There is some additional potential exports going to places in the EU, for example. Even India got a little bit of a bump. But again, it's really hard to kind of entirely replace exports to the U.S. So even though exports fell to the United States to their lowest share in many decades at this point, it's still more than 2/3 of exports leaving Canada are going to the United States.
Oh, I know, as you mentioned, it's only sort of 1 month's worth of information we're looking at, but do we even know what is going to other countries that perhaps wasn't going there before?
Yeah, it's, again, a little too early to make those broad conclusions. We had, for example, something like quite a big driver of exports this month were just driven by gold going to the United Kingdom. That's not something that we would expect to continue in the next few months, let alone months from now. So again, it would take a few months to kind of see if there are any major trends that we can pull from this data.
You mentioned that it's hard to pivot away from the U.S., and we're going to see maybe baby steps in that process. Remind us why it is so hard to do that. I mean, the relationships are long-standing, but also some of the process that's embedded is well embedded.
For sure, yeah. I mean, like you said, there are many existing processes. We've come from many decades of tariffs either near zero or at least declining up until this year. And so this is a huge change in a very short period of time. So it's going to take years, really, to adjust to this new normal. Some of the practical implications, I mean, the United States is the largest economy in the world. Their consumers are, the richest consumers in the world. And so that's not something that you can totally move away from. It's hard to find substitutes for U.S. consumers. But also, it's, the United States shares the longest land border with Canada. That's something that doesn't change. So even despite these additional risks or uncertainty or tariffs, all these extra costs in sending something to the United States, it still might be cheaper or more efficient to sell to your southern neighbor rather than to someone else across Canada, just because of how Canada is structured, let alone to someone across an ocean. So some of those things are things that are very difficult to change.
So, well, speaking of oceans, we're sending LNG now to Asia, the first tanker that went off the West Coast this week. Is that an opportunity for diversification of markets if we get that going the way it's believed to be able to?
Yeah, it certainly is. And I would just highlight that as one of many examples. We see a number of trade deals already having been signed with countries in Asia, with countries in the European Union, and a number of projects coming out of that. And so if there's any positive that we can get for Canadian exporters in this new environment, it would certainly be these kinds of opportunities to go elsewhere and to look elsewhere.
The trade deficit with the U.S. that we have and the way we expect it to move, how do we expect that to affect GDP moving forward?
Yeah, so trade hits GDP through net exports, so the value of export volumes minus any price moves, minus the value of imports, again, minus any price moves. So those net exports, that trade balance is likely to remain under pressure. A lot of that is just because exports are going to continue to be weighed by this all of this trade uncertainty, at least until we get to a world where we have some sort of normalcy, whatever that normalcy looks like. That will allow consumers, businesses on both sides of the border, as well as elsewhere around the world, to have a little bit more faith and to be able to make those purchases.
What's your expectation for the discussions? Because, as you know, Canada clawed back the digital services tax. Two sides are going to be talking again with that July 21st deadline now in mind. Does that seem like enough time? Are you optimistic that this is going to work its way through and perhaps give us some of that certainty that people have been missing?
If you were to ask me that 6 months ago, I would have said, no way, that is not enough time. We have seen a number of times at this point, this new administration likes to make deals, let alone trade deals, very, very quickly. So it's certainly on the table. It's a possibility, but so is a possibility of potentially delaying this July 21st deadline. I don't think there's any sort of indication that would push me in either direction at this point. It is encouraging that the trade talks have continued and have resumed, but you know, things can change very quickly, and they can change quickly at the last minute. So I won't believe it until I see it, really.
You know, the Bank of Canada governor is looking for clarity. The bank has said that for some time. Until we know how the tariffs are shaking out, we're not going to make a move. We're seeing that in the U.S. as well. This is a little bit of data that we have now to add to that picture. What's your take on the Bank of Canada's next move?
Well, the Bank of Canada governor is waiting for certainty, so are we. So is everyone else, really. There's kind of two things going on here. One, we know that inflation is elevated, even though headline inflation is below the 2% target. The measures of core inflation, underlying inflation, are still quite hot, hotter than the Bank of Canada would like to see. So that in and of itself would indicate that, you know, the bank has some reason to be a little bit more cautious. But on the other hand, economic growth is slowing. So we saw the economy contracted in April, likely contracted also in May, and this also adds to that theme. The deep trade deficit really adds to the theme of the economy slowing due to the weight of these tariffs. And so that piece of the puzzle is kind of what would be pushing the Bank of Canada to potentially cut further. So as of right now, we still have a little bit more time until that July meeting. It's not till the end of the month, and so we actually have another inflation report, which will be quite interesting to see, because it'll tell us whether inflation is, you know, starting to step down or remaining quite sticky. So as of right now, seeing all of these indicators pointing in different directions, we are still calling for a cut next month. But again, there's quite a bit of data. There's quite a lot going on until then.
Yeah, it sounds